Hello and welcome to VanEck. I'm your host, Will Beeson. Nick van Eck is the co-founder and CEO of Agora, a US-based stablecoin issuer backed by Dragonfly, General Catalyst, Galaxy, Consensys, Wintermute, Flowdesk, Kraken Ventures, and more. Agora's strategy is to build distribution through B2B partners via a revenue sharing model, in which all parties that contribute to Agora's stablecoin's success share in the upside. Nick's grandfather started VanEck Global, a US ETF and mutual fund manager, in 1955. Today, the firm manages $100 billion across a range of products, including recently launched Bitcoin and Ethereum ETFs. In this conversation, Nick and I discuss crypto as an asset class and parallels to gold and other investments, the current state of the stablecoin industry and its future trajectory, Agora's thesis vis-à-vis incumbent stablecoin issuers like Circle and Tether, Agora's operating model and the details of its go-to-market, and much more. Thank you very much for joining us today. Please welcome Nick van Eck. Nick van Eck, welcome to VanEck.
Thank you for having me.
It's great to connect with you. I've been following your work at Agora over the past number of months now, and have been looking forward to this conversation.
Sounds great. Let's do it.
I think it was Rob Haddock from Dragonfly that introduced us, right? They participated in your most recent fundraise?
Yes. So Dragonfly led our seed round that took place at the end of last year.
Were there a number of investors involved in that? Was it more angels, more funds?
Yeah. So we had a number of strategic partners that also invested. So my prior firm, General Catalyst, invested as well. Wintermute, Galaxy, Consensys, Marana, Kraken Ventures, as well as Foresight Ventures. So a number of exchanges, market makers, strategic providers in the industry. From my prior background as a venture investor, know well that your cap table can be a weapon. And so we wanted to make sure that we had a lot of strategic partners on board as well. And in addition to those strategics, we had a number of great CFI, DeFi related angels that we've known from our prior roles, but also that we were introduced to during the process.
Makes sense. And probably a reflection of the relevance of the stablecoin theme and also the background that you bring to bear on this unique and interesting challenge. Actually, maybe picking up from there, you mentioned to me one time that you developed a curiosity for financial markets because they require expertise across many domains. I wonder if that idea applies at all to the work you do now.
I think it does. Our first product is a one-to-one digital dollar. And so at the core of it, it's money. And money can be used by a variety of different types of institutions and individuals. And what our model is proposing that's quite different is being neutral money. So if you look at Tether and USDC, both of them have affiliations with exchanges. In USDC's case, they share half their income off platform with Coinbase. And our view is that you should create value to people that drive utility and liquidity to your asset. And we work with PSPs where they control the end-to-end asset that they're choosing, DeFi organizations, centralized exchanges. And so it requires knowledge of a bunch of different types of business models and businesses, liquidity, market structure, right? You're integrating with DEXs, lending applications. And so I feel like there's always something that we're learning as we interact with these different businesses that are making choices about what stablecoins they use and offer to their customers.
I think stablecoins are a particularly interesting space right now because they, of course, got their start in a purely crypto environment. And more recently, it seems like there's increasing traction in quote unquote real world or real economy use cases. We connected with Banu Kohli of Layer 2 Financial recently. They're doing cross-border payments using stablecoins. And I think the view of a lot of stablecoin builders and certainly investors that are funding stablecoin projects is that ultimately the TAM for stablecoins is basically global economic value, which of course implies that a lot of real economy use cases end up being powered by stablecoins. But at the same time, to build a business, you have to start where the activity is. I wonder how you think about that question, I guess. Crypto native use cases, things like centralized exchanges, decentralized finance as a relevant quote unquote target market, a collection of partners for you to work with at the outset, versus where we are on the maturity scale when it comes to real economy use cases for stablecoins.
I think ultimately this is a multi-decade journey. And the core users of stablecoins today are primarily participants in and around the crypto ecosystem, although I believe that that's starting to change. So if we look back at stablecoin history, Tether first got going about 10 years ago, and they were the first firm to really bring digital dollars on chain, and they were solving primarily for a trading use case. Folks remember back in the mid-teens, BTC was the primary quote asset on many of these centralized exchanges. And the issue with that is you may not want to be using a price volatile asset as your quote token or store of value. And Tether really solved for that. Then you had the second wave of really exchange-backed stables in 2018, 2019. So you had USDC, which was Coinbase's hat that they threw into the ring. You had Gemini USD, Binance USD, and I would say it was characterized by a very similar market structure. Most of the things that you were doing at the time in 2018, 2019 were all centralized exchange related. DeFi hadn't had its huge moment yet. You didn't have as many chains and VMs that you have today. Qualified custodians hadn't really come into the space and brought in traditional financial institutions and other providers. You hadn't had the explosion of consumer. And so stablecoins really started out, in that sort of trading use case as a means of collateral. I think over the last few years, we've seen that expand beyond centralized venue to decentralized venues, multiple chains, but also net new use cases. I think we've just started to see PSPs and payment providers start to use stablecoins as a way to move money on the back end. And I think over the next 10 years, we'll start to see banks and many traditional financial services and payment participants start using stablecoins because they are truly 10 to 100x better than the status quo, which is using the corresponding banking system to move money cross-border. And even in the United States, if you're not moving it cross-border, you have the inability to move it 24/7 with the current banking system. And so if we look at it from a first principles perspective, why this technology is valuable is because you have instant settlement and low transaction costs. And that expands ultimately the addressable TAM to M1. And really what we're going after is the Eurodollar market, which are US dollar deposits that are in offshore banks. And I think over the next 10 years, we'll start to see stablecoins really pick up in their penetration of businesses and use cases. But today it's primarily crypto. But if we look over the longer term horizon, and I would say our core customers today are very much crypto natives and people within crypto. But I could see us in 5-10 years having commercial banks, global payroll providers as being some of our largest customers, but they're not there yet. And I think to get there, we need to have regulation and clear rules in a number of jurisdictions, but also the infrastructure and the tools that make individuals who aren't familiar with crypto and using wallets comfortable with using these instruments to transact. So I think 10 years, 20 years down the line, almost every traditional financial service business or payment provider is interacting with stablecoins in some manner.
You mentioned mid-20 teens, Bitcoin basically being the only game in town. I think there's some interesting parallels, actually, and hear me out. I understand that your grandfather started the first gold fund in the 1960s.
Yep.
Can you tell us that story and any parallels that you see between gold in the 1960s and Bitcoin now?
Yeah, I think in many ways, Bitcoin was in my blood. My grandfather started VanEck, which is an asset management firm, in 1955. My father is the CEO and runs that business today. He really started it looking for innovative strategies. They were also one of the first firms to offer international equities to Americans, which was not easy to do at the time. But he studied under Ludwig von Mises, who is a famed Austrian economist, and saw the inflation and really the high spending in the 60s and thought it would lead to inflation. And he thought it would lead to the Treasury abandoning the gold peg after 200 years, which is really something quite crazy to believe in. And so he set that fund up in 68, and the peg was abandoned in 71, and gold really ripped, right, as we had this massive inflationary cycle in the 70s. And I had sort of grown up in that environment of gold bugs and people that took the federal debt levels and spending very seriously. And so I was actually working for a hedge fund in the summer of 2016, and the partners were buying Bitcoin at the time. And it was the first time that there were, say, traditional financial service folks and investment professionals that I knew that were looking at this asset class. And they were running a multi-billion-dollar fund. And I said, hey, they probably know, they're probably smarter than I am. So maybe I should at least take a look and read the white paper.
They're buying it for the fund or PA?
PA. And so I sat down, read the white paper, and it immediately resonated with me. And in many ways, I felt it was a 10x better version of gold because it was much more portable. Anyone could access it with an internet connection. There was a fixed supply, and it was really like the ultimate non-sovereign asset. And so that's actually what first brought me into crypto. Was working at that fund that summer. I evangelized a lot of family and friends. I thought, maybe Bitcoin will be the means of transaction globally, like the non-sovereign means of transaction. But obviously, when you have something with so much volatility, it's really challenging to be a means of transaction. And in some ways, a store of wealth over the short to medium term. Maybe over the longer term, it could be a good store of wealth, but over the short to medium term, people want something that's more familiar with what they're doing on a daily basis, right? Which is the US dollar. And so, yeah, I think in many ways, Bitcoin can be a replacement for gold, and that's showing up. From my own personal perspective, given my background, I didn't really have that much of an interest in buying physical gold, but I wanted to buy Bitcoin, right? And I was like, so if someone with my background and family history is more interested in buying Bitcoin than gold, I think probably a lot of people in my generation will feel very similarly.
You mentioned fintech payment companies and PSPs, and you view them as being ultimate partners of yours at Agora. And I imagine also that in your work, maybe at General Catalyst, you would have come across a whole range of fintech companies, both portfolio companies and potential investments. What's your sense of what we saw, the progress that we achieved during the last fintech innovation cycle when it comes to payments specifically, the Stripes of the world, Adyen, what are now large and in many cases public fintech payment processors versus, I think, views you may have on some of the real underlying power in payments innovation?
They're all very valuable companies, but what they didn't change was really the back end. So Stripe's core innovation was they made it really easy for businesses and merchants to accept credit card payments online. That was the first product that they did, which was extremely hard. And if you read like the history of PayPal, accepting payments online was a really big challenge. But ultimately, from my perspective, that was demand aggregation and making it easy for merchants to really branch out to the internet and service a larger pool of demand. There were other new neobanks that I would say are much more consumer focused or service specific niches like Chime. Right. So there's been a lot of customer segmentation that's happened in fintech over the last decade and a half. TransferWise helped people move money cross-border, much quicker and cheaper than with traditional banks and traditional providers. But what none of these fintechs really did was change the underlying rails. They're all still using ACH, Swift, and they're not fundamentally changing how fast money can move. So what Wise did and TransferWise is they actually just set up accounts in different jurisdictions and just changed the balances, within their own internal ledger. Whereas with crypto and stablecoins, we're actually really moving that asset instantly globally, which is a huge innovation for businesses and is really the back-end innovation that I think never happened in fintech. And things like instant settlement and programmatic payments and lower transaction costs and even censorship resistant payment rails may not be as interesting as, hey, we're going to 10x your revenue in a month, but it really changes the capital efficiency of many of these businesses in a net positive way and also reduces costs for the business and ultimately consumers. And so I think that's what crypto really is. And if you're a believer in crypto or blockchain, however you want to articulate it, it's really a bet that the back end of financial services and payments is going to move on chain in the next 10 to 20 years. And I think we're starting to see that. And the train's just starting to really pick up steam. And over the next 10 years, I think you're going to see a dramatically different landscape than you're seeing today.
There are two fundamental concepts here. The first, it sounds like, is that real economy payments activity will, over some time frame, which may be in the years or low number decades, move from a purely fiat, call it asynchronous payment world, into a digital asset-based stablecoin payment world with 24/7 money movement, instant settlement, atomic swaps, where basically the transaction information and the payment all happen in the same moment.
Yep.
And a corresponding reduction of counterparty risk and other benefits. That I very much agree with, basically the stablecoin thesis in a sense. And then the second element, right, is basically the optimization or improvement, or the area for improvement that you see with respect to the existing stablecoin space. So you described Tether and USDC. Fundamentally, they are non-yield bearing assets. They're digital representations of dollars that are held in bank accounts or custody accounts, and which are generally invested in high quality yield generating assets. And the business model of the issuer is basically to take in $100, issue $100 in stablecoins, and invest that $100 in cash in, say, US Treasuries, earning 5%, and keep the spread, the yield on the portfolio. And the Agora model is basically to share the yield on the collateral with the users of the stablecoins. Is that a fair, simplistic description?
There's a few things I would tweak or maybe add. So if we want to really hone in on the USDC model, they started as the center consortium with Coinbase. So it was a 50-50 JV with Coinbase where half of the income of that joint venture goes to Coinbase. And they announced last summer that they were officially separating the issuance, but that the economics share would remain in place. And I think that's why you're seeing Coinbase push USDC on Base so aggressively, as well as across their platform. Our view was, and my view, is that ultimately this isn't fair because money should be neutral. I think people's first thought as rates rose and attention was directed on how much money Tether and USDC Circle were making, and even Coinbase, right? You just look at the quarterly filings at Coinbase's interest income. Why aren't users benefiting in that? And so I think there's a concept of these yield-bearing stablecoins. Those don't work for a number of reasons, and I'll explain. Right? One, they're clearly securities products.
Yield-bearing meaning you're paying the yield that the underlying collateral portfolio is generating back to the users of the stablecoins, the holders of the coins.
Correct. It's natively yield-bearing. And whoever that wallet address is, it's natively accruing yield on a daily basis. And so the biggest challenge is with that, one, it's a security product. So you can't freely transfer it. In many jurisdictions now, stablecoin legislations are being defined as one-to-one. So you saw that with MiCA in the EU, and I think we're seeing that globally. So one, they're a security product. Two, there's serious compliance issues around interacting with the banking system and treasuries and paying people that you don't KYC and KYB, because you could be potentially paying bad actors if you're natively distributing yield or income without having any compliance checks in place. And then three, they really have no margin. They're making 10 or 15 basis points. And as a stablecoin provider, you should be trying to maximize utility and liquidity. And so what we're doing that's different is saying, hey, it's businesses that are really driving utility and liquidity to these assets because they're having their users use it or they're listing it on their venue. And we're saying they should benefit as part of that monetary network, and especially if they're driving utility to these assets. And so what we do is we have an open model. If you're a payment provider, a fintech, an exchange, whomever, as long as we can KYB you and you sign a commercial services agreement, we'll share the majority of that net income with that business. And then ultimately, it's up to that business to choose how they use that new cash flow. They could use it to pay for more devs, increase their security budget, pass it through to users via marketing programs. It's up to them. And what we're doing at Agora is trying to redistribute the $8 billion that was rent-seeked out of crypto back to businesses, and then ultimately through those businesses to their users through better products, better customer support, whatever it is. And I think that's resonated with a lot of people. And in addition to that, we're net neutral. We don't have preferential treatment of different parties. And that's what money should be. You shouldn't be worried if you're MetaMask or Bybit or Solana that half of the income of the money that is sitting on your platform is going to fund one of your biggest competitors in Coinbase. And so I think now the market is developed enough where people are saying like no more, and they want a neutral provider that is transparent, has institutional grade financial services partners, works with reputable audit firms to come in and be that neutral layer of money that is also creating value to businesses and really the builders that are building across the space.
And the concept with Agora is that the company issues, say, one USD stablecoin and maybe one Euro stablecoin, or that it's kind of a white label stablecoin as a service type business. If I'm a big e-commerce platform or something and I want to stand up an internal stablecoin to facilitate all of the economic activity on my platform with merchants and clients and things like that.
That's what's beautiful about this model, right? Is that we're effectively everyone's stable without them having to run their own white labeled stable or compliance program or build up network effects, build up liquidity across venues, because they receive the economic benefit as if it was their own stable on their own platform. And then they benefit from the shared liquidity, right? Whether it's in DeFi and other venues. That's resonated with a lot of people because from an operational and compliance and a cost standpoint, it's negligible now. They sign an agreement with us where they're earning 70, 80% of the net income. It's just as good. And there's some folks that have come to us and asked to white label AUSD, where AUSD is really their stable coin under the hood. We're thinking about that as well. And in cases where it may make sense, like gaming or other environments where you really just want to have like a custom branded experience for the user. But in more traditional financial services venues, like it makes much more sense to just be using AUSD and having an agreement with us, because if someone wants to send it off exchange into DeFi or payment provider wants to procure it for their own business, it makes for a much more consistent network and experience.
From a practical standpoint, business onboards with Agora, they undergo KYC, you basically approve them as a partner. How will they then interact? They will have mint and redeem privileges. Is that the way it works?
So it depends. We have our web application and interface and really two thresholds for KYB. If you want to have mint and redeem access, that is a more intensive process where we document the UBO, source of wealth, and really are holding our customers to the highest standard. So they will have mint and redeem access if they go through that, but they also have a dashboard, right, where they provide wallet addresses that they want us to track, sign a transaction to prove ownership. And then we want to make it as frictionless as possible for these businesses. And so what we do then on the back end is just index the chain and say, hey, there's been this much activity that you've driven to us, and then provide them a statement that goes through the activity report and says, we owe you $10,000 this month that we're going to pay out to you in AUSD. And it's very transparent, but ultimately think about it like your typical bank portal or financial application. You can log in, provide wallet details, etc. And once you do that setup, it's relatively autonomous. We're going to be baking in a lot of other features over time, but at the beginning, we want to make it as frictionless as possible, where they provide their wallet address and then we do the rest behind the scenes and on the back end.
And so those clients of yours, those B2B clients would, at least the Minter Redeemer clients, they would send you stablecoins and or wire fiat to create new AUSD?
We support multiple forms of subscription. Ultimately, we need to receive fiat in order to mint AUSD. But we can take USDC, USDT to subscribe. And then what happens on the back end is we have an OTC desk, swap that to fiat. They send us the fiat. Once the fiat hits our bank account and settles via wire, then we can mint the AUSD. So we want to make it as easy as possible for our customers to come over from other assets to AUSD. But we do have to take in fiat to mint AUSD. And so if it's a stable coin or some other asset, that is going to be swapped on the back end by an OTC desk or some other provider.
These are Web3 businesses to start, I imagine. It sounds like a relatively Web3 experience.
I would say primarily Web3 or crypto aware or crypto native businesses. Some of our early customers include exchanges, institutional trading firms, decentralized stables actually are great partners of ours. Some actually payment providers have already gone through the onboarding process. So we're starting to break into that more traditional category already. I would say the vast majority of our customers are crypto native. And I expect it to remain that way for the next couple of years until traditional businesses start to feel comfortable using crypto or it becomes inevitable. I actually was talking to a business. They're a remittance company. They do a lot of remittance between the United States and Mexico. And they sort of know that this is inevitable. And they even said like, hey, we want to like hold on to our juicy margins as long as possible. And so they said, yeah, check in a year or two, which I thought was interesting. Is like, even though they know this is inevitable, they're afraid to cannibalize their own business. Even though if you listen to like Steve Jobs, it's like, if you don't cannibalize yourself, someone else will. But I think 3 to 5 years from now is when we really start to see non-crypto actors start to move into the stablecoin space much more aggressively, either because they're comfortable with regulations and the tools that are available to them, like Fireblocks, or because they need to out of a business necessity, right? And they just have to compete or they go out of business.
Is your view that if we talk about real economy use cases, let's go back to that e-commerce hypothetical example, that the end, say, retail users or small business users of the platform, i.e. your customers' customers, in a sense, would likely be handling or transacting in or interacting with stablecoins from their perspective, or that it would more likely be kind of wrapped in a Web 2 or fiat-based experience that happens to be powered by AUSD or stablecoins on the back end?
I think it'll be a combination of both. And it depends on where the business is. The two core use cases for stablecoins today are cross-border payments and EM latent dollar demand. And so I think in a lot of emerging markets, you have people that want to hold stables because either a bank won't serve them, they have really high inflation in their local currency, or low rule of law, and stablecoins are just a better alternative for them to store their wealth. In those jurisdictions, I think you see a lot of end retail users using stablecoins as a means of payment. You don't see that in the United States. If we're being intellectually honest, Venmo works just as well as stablecoins for the most part. But where it does move the needle is traditional financial services. If you're a bank or a trading firm that wants to move risk 24/7 or needs to do things over the weekend, stablecoins are a great alternative. And that's an example where it's under the hood, or it could be directly interfacing with their end customer. Another area where it is very much clearly under the hood is anyone that is dealing with cross-border payments. You could have sort of that Web 2 interface where it just shows up in your account as $1. You don't even know that it's AUSD under the hood. But that business has chosen to use stablecoins because you can see, hey, I sent that transaction, it'll arrive in 5 seconds versus I don't know when it's going to show up. We actually had a few angel investors in our business, and one of them, it took 12 business days for the fiat cash to arrive. These were both investors from the APAC region. And then another, it took 25 business days. Right?
No way.
That is, and we had no idea where it was. That is unbelievable. And think about that. We didn't need it in a timely manner, so it was okay. But think about if you're a business where you need something done like the next day or that week.
In that case, some percentage of it is basically it's sent on a Friday, so it doesn't get processed until the Monday sort of thing. And then maybe there's a correspondent bank involved, and then there's a holiday. Okay. Some of that had to have been banks freezing or holding, waiting for some sort of time window to pass for it to, quote unquote, fully clear before they felt comfortable taking the risk, in a sense, of sending it on.
Yeah.
Wow.
But it's interesting. There's sometimes no rhyme or reason to it. I have someone who sent 2 transactions from their bank in Spain to the US, same day. One of them arrived in 2 days. The other one arrived in 17 days. They were similar amounts, small dollar amounts. And so for whatever reason, one of the transactions got held up and they were going to the same end account. If you aren't interacting with the system, you don't know how slow and opaque basic transactions and commerce has become when it involves money moving cross-border. Even if the counterparties are known and it's regular course of business. And this is a massive innovation, right? I think we talked earlier about who our customers are today. Ultimately, I want Pepsi to be my customer in 10 years. They have commodity producers in various regions, whether it's Mexico or Southeast Asia. They have distributors in various regions. They're paying people cross-border and globally on a daily basis to the tunes of probably hundreds of millions, if not billions of dollars. And this can massively improve the capital efficiency of that business because they don't have to pre-fund accounts. There's no factoring, just instant settlement, low transaction costs. It's beautiful. So I think that's what our customer actually looks like in 10 years. And we don't even maybe need to directly serve them. They're just using a USD because that's the digital cash equivalent that they're using under the hood to move money globally.
What regulations are most relevant to you, and how complex is it to comply with them?
In the United States, it's money transmitter laws. We obviously don't have federal legislation yet. I'm hoping that we get it soon. So I think ultimately, not only can stablecoin providers do a great service to the United States in supporting the federal debt and expanding the utility of the US dollar as the global reserve currency, I think it can do a lot of good on the economic side as well. So that's where we are in the United States. In Europe, they just passed MiCA, which imposes a few different requirements than what we're expecting to be the norm globally. So there's a capital provision of 2%, but also you can only keep your assets in bank deposits. You can't keep them in overnight reverse repo or short-dated US Treasury bills, which we view as the safest assets because your counterparty is the US federal government versus a community bank. And we saw a year ago how keeping your assets in bank deposits can actually be a really unsafe place to store them with the deep peg that happened with another provider.
The 2% capital requirement, that's basically equity capital of the stablecoin issuer in the same way that a bank would hold tier 1 capital?
It's actually way more restrictive than banks. Banks have the fractional reserve banking system. They may only need to have 15% or 20% on hand to match their outstanding liabilities. So you see all these news articles saying, oh, this bank is going to launch a stablecoin, or I don't think that happens because we have to have our assets backed one-to-one at all times, whereas that's not true in the traditional banking system.
But then the capital provision is basically 2% capital against your assets, which would be your collateral portfolio.
Right. So you have to have 102% of what your outstanding assets are on your balance sheet or on behalf of customers, which is, I think, provides consumers and businesses with a lot more comfort that, hey, your assets, not only are they backed one-to-one at all times, they're actually over-collateralized, which is not true in the traditional banking system and with bank deposits. So
that feels reasonable though, right? I mean, if you're literally precisely one-to-one, any issue means that now you're underwater with respect to your entire issuance.
Correct. So that's Europe. And then in other jurisdictions, we're seeing similar rules to what we expect in the United States, where it's okay to have treasuries, it's okay to have overnight reverse repo. Hong Kong is trying to finalize their legislation this year. The UAE has some legislation in place. Bermuda has legislation in place. But really, I would say the federal legislation is just in the early innings in many jurisdictions globally. And so what we need to do in the interim is hold ourselves to the highest standards on the compliance side, which starts from day one. Our head of compliance was our first non-founder hire. We take it really seriously, having the software tools in place to do that. And then just keeping track of legislation as it comes. I think everyone has a pretty good idea of what to expect, and many regulators have tipped their hand in what they're planning to try to pass. And so to us, it's very clear that you need to be backed one-to-one at all times, in the highest grade assets, which is overnight reverse repo, US short-dated treasury bills. We use one of the largest custodian banks in the world as the cash custodian and the fund administrator for our assets, and VanEck is the asset manager behind it. So you have a 70-year-old asset manager that manages over $100 billion that's globally licensed, managing the money on behalf of outstanding AUSD holders. And we're getting licenses in all the jurisdictions that are necessary. So we already have MTL licenses in the United States. Although we don't serve U.S. customers directly yet, we're waiting for federal legislation. We have a VASP in Europe as well, and are working on EMI there soon. But that's how we think about it. And ultimately, I think a lot of regulators are keen to move on this legislation quickly because it's really important. And I think they view it as the future of financial services and money movement.
How much of the stablecoin opportunity and the enthusiasm around stablecoins right now is a function of the steeply inverted yield curve? And to what extent will yield curve normalization impact interest in and activity around stablecoins in your view?
I think what the inverted yield curve brought attention to is just how profitable the duopoly of Tether and Circle are. Ultimately, our view is like your margin is our opportunity, and we want to fairly accrue value back to businesses, which is why we only end up taking a small spread. And most of the value is being returned to these businesses that are utilizing these assets. And what we use that small spread for is compliance, running the business, maintaining liquidity programs, which are extremely important for utility. And so I think you're going to see a lot of margin compression on the stablecoin side, but I think there'll be continued massive excitement in stablecoins because it's in some cases anti-cyclical, but it sort of goes past cycles. There's no price appreciation or speculation around the price of stables. There's interest in this asset class because of the fundamental like first principles that these enable, right? Which is instant settlement, low transaction costs, programmatic payments. Really, anyone can kind of be their own bank. Something that really interested me in Bitcoin and now stablecoins is you can do a lot of good with these assets. My grandmother and my great-grandfather fled the communist secret police. They had to leave all their belongings behind. Stablecoins can be that mechanism and store of value where people just keep it in their head or in their pocket. You have women in Afghanistan that can't get bank accounts. Well, with AUSD or even USDC, USDT, obviously, they can protect their own assets. I think that's what's really exciting beyond, obviously, the innate back-end innovation that stables provide to many businesses. And so I think there's a lot of reasons why folks are interested in stables as we attack the margin of the cartel and this duopoly of USDT, USDC. I think there may be less interest in that as there's a new normal, but I think there will continue to be interest in the utility and economic freedom benefits that stablecoins enable globally.
Final question for you before we wrap up. What stage is the business at right now, and what are the next major milestones that you're excited about?
I left my prior firm in October. We closed the final close of our seed round in January of 2024. We launched on Ethereum, private beta about 2 weeks ago. We have about 40 million in AUM. We are going to be deploying on several new chains soon. And so the biggest milestones for us, which we expect to hit over the coming weeks, are 100 million and then 500 million in a few months' time. And by the end of this year, we want to be over the $1 billion mark. We'll be on a number of different large centralized venues by then, as well as several different chains. Ultimately, I want us to be the most liquid digital dollar on the globe.
Private beta on mainnet with 40 million in fiat invested in live funds.
That's correct. Yeah. By private beta, it's all real. By private beta, we mean early customers that are working with us as we get this off the ground, that are giving us advice on the web app and other things. We'll be launching liquidity programs in the next couple of weeks, and that's sort of when we'll be out of this limited availability phase. So stay tuned for that.
Nick, I'm very excited for what you guys are building. It sounds like you have not only the vision, but also a collection of partners and stakeholders to move very fast and build something big on an accelerated timeframe.
Thank you. I appreciate that.
Nick van Eck, thank you very much for joining us today.
Thank you for having me, Will.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.